You are welcome to another interesting area of principles of financial accounting known as the preparation of statement of profit or loss account and other comprehensive income. The old name for this account is trading profit or loss account. That is under GAAP. But under IFRS, International Financial Reporting Standard, it is called the Statement of Profit or Loss Account and Other Comprehensive Income. Since we are still in our foundation stage, and for a better understanding of this topic, we are going to divide our learning into parts. The first part will be the trading section or part. In the trading section, we are going to find out what is known as the gross profit. And gross profit is simply the difference between sales and purchases. For instance, if you purchase goods for $500,000 and sells it for $700,000, the difference between $700,000 and $500,000 is $200,000, and that is your gross profit. So simply put, we are going to look at the difference between sales and purchases. But the question is, what makes up the sales and what makes up the purchases? This is the first part of the statement of profit or loss account and other comprehensive income. The first part we are going to be showing is the sales portion. Now, as the owner of Victory Enterprises, at the end of the period, accounting period, which is usually 12 months, we have come to calculate the total amount realized from sales. Of course, we are not looking at the cost of the goods we have purchased. We are looking at the sales in the first place. The sales will be calculated and what we call sales returns taken into consideration to find out our net sales. After selling some goods, you will discover that some of the goods sold may be returned for one reason or the other. So the treatment in the sales is to calculate the total amount realized from sales and deduct from it the returns inwards, otherwise known as sales returns. It is when you deduct the returns inwards from the sales that you now find out the total amount realized from sales in the period. The first thing we are going to do is to show the name of the organization we are preparing the account for. Here it is Victory Enterprises. And what account are we preparing for Victory Enterprises? It is the statement of profit or loss account and other comprehensive income for the year ended 31st December 2021. Of course, an accounting year usually runs for 12 months. So if this account is ending by 31st December 2021, it means that Victory Enterprises started operation from 1st January 2021 to 31st December 2021. If you calculate from 1st January 2021 to 31st December 2021, it will give us 12 months. And now, we said the first part we are going to show in the preparation of statement of profit or loss account and other comprehensive income is the trading aspect showing the sales. Now, from the calculation in the organization of Victory Enterprises, they have arrived that the total sales made in the period is $360,000. That is sales, which can also be called revenue. $360,000. Some people they sold the goods to return some, probably because they do not meet their standard or probably they are bad. And when this occurs, such returns will be deducted from the sales made. As you can see, we deducted $1,000 from $360,000 to obtain $359,000. These returns of $1,000 is called returns inwards or sales returns. Of course, it represents goods sold but was later returned. The $359,000 represents the net sales. The question is, how did they get the goods they sold? Of course, you cannot just sell goods without buying it. So the next stage we are going to calculate is to find out the cost of the goods they sold in order to obtain this $359,000. So that brings us to the aspect of trading account known as the calculation of cost of goods sold. So to calculate the cost of the goods sold, we're going to be looking at what the company has to sell. Firstly, we are going to consider whether they have what we call opening inventory. What is opening inventory? In this our illustration, we assume that Victory Enterprises has already been operating as a business. And it is possible that whatever Victory Enterprises is selling, there are some unsold stock at the end of the previous accounting period. Now, if there are some goods, let's take for instance that Victory Enterprises sells school bags. Now, and Victory Enterprises has been operating for more than 10 years. Now that we are preparing the account of 2021 ending, it is possible that before they entered January 1st, 2021, they have some unsold stocks of school bags. Now, these unsold stocks of school bags will not be thrown away. It will be brought forward from the ending of the previous year, 2020, December 31st, to 1st January of 2021. That is the current year that we are preparing the account. So in a situation where they have unsold stocks of what they sell at the previous accounting period, the first thing that will be taken into consideration is to bring it forward. And when you bring it forward, it will be tagged or called opening inventory. So we have the opening inventory, $10,000. Remember, we are trying to find out the cost of the goods sold. We are using the second line of the dollars to calculate the cost of purchases, that is the cost of goods sold. And we have gotten our opening inventory as $10,000. After obtaining the opening inventory, which represents unsold stock of the previous accounting period brought forward, the next thing we look at is purchases. Since the opening inventory will not be enough for them to sell in the accounting period, they will go to the market and purchase more. The accounting treatment is to add the purchases to the opening inventory. Then we take into consideration whether there is carriage inwards or carriage on sales. After purchasing the goods, it is possible that Victory Enterprises will spend some amount for carrying the goods from the point of purchases to the business premises. If this occurs in the equation, what it implies is that the purchases is now made up of total cost of goods purchased plus the carriage inwards or carriage on sales, which looks like transportation cost. So let's consider purchases plus carriage inwards. So to the opening inventory, which presents old purchases, which is $10,000, we add the new purchases, which is $150,000, and add the carriage on purchases, which represents the amount used in carrying the goods purchased to the business premises. So we now have 10,000 as carriage on purchases. If we now add 10,000 plus 150,000 plus 10,000, it gives us $170,000. These are the things that makes up the component of purchases, but it is not yet over. Let us consider what we call returns outwards. The next thing we take into consideration in calculating our cost of goods sold is returns outwards, which can also be called purchases returns. It is possible that after purchasing these goods, there are some that does not meet our standard. For instance, if we purchase school bags and some of these bags purchased does not have zip or does not have handles, the possibility of we taking it back is high. So if we return such goods does no longer form part of our purchases. The accounting treatment is to deduct such purchases returns from the total cost of the goods purchased so far. So we are going to go and minus from the cost we have obtained what is known as return outwards or purchases returns. Return outwards or purchases returns is $2,000. And when you deduct $2,000 from $170,000, you have $168,000. Remember that we have the opening stock, which is old stock, plus new purchases, plus transportation, which we call carriage on purchases, giving us $170,000 as the cost of goods available for sales. Then when we deduct returns outwards of $2,000, it gives us $168,000. This is what is called in accounting the cost of goods available for sales. That is $168,000. Now we have gotten the cost of goods available for sales as $168,000. Remember that this is made up of opening stock plus purchases plus carriage on purchases less returns outwards. The question is this: was all these goods of $168,000, which represents goods available for sale, was all of them sold? We can find out this by investigating our stock. Assuming at the end of the period, we discover that not all the goods were sold. It means that these goods of $168,000 has not been sold. It is when we calculate the ones that are available and deduct it from the total $168,000 that we can now arrive at the actual cost of the goods that was sold for the period. Let us assume that we counted the remaining bags in the warehouse and discovered that bags of $8,000 has not been sold. What it means that the only stock available at the end of the period, which can be called closing inventory, is $8,000. So out of $168,000 goods, the only one that is remaining unsold is the one of $8,000, which implies that the ones that have been sold is $160,000. How? $168,000 of goods available for sales, which constitutes all the goods in the warehouse, both opening stock, old purchases, and current purchases, and other things that we are taking into consideration, is $168,000. When we deduct the ones that is available in the warehouse, that is goods of $8,000, what it implies is that the one of $160,000 have been sold. These goods of $8,000 that was not sold at the end of the accounting period is known as closing inventory. So to get the cost of the goods sold, it is goods available for sales, which is $168,000, less the closing inventory of $8,000, which will now give us $160,000. So if you less closing inventory of $8,000 from $168,000, it becomes $160,000. Instead of writing it here, we extend the balance, 160,000 in bracket, meaning it is deduction. Where are we deducting it from? From our net sales of $359,000. Remember that this sales was gotten from the selling of these goods of $160,000. But following this format, the first thing we did was to calculate the sales. It is possible that we calculate the cost of sales firstly, but we decided to calculate the sales in line with the accounting format. Now, it was these goods that cost Victory Enterprises $160,000 to purchase that was sold for $359,000. So we now have sales minus purchases, which gives us $199,000 as our gross profit. Remember that when we started, we said that gross profit can be gotten by looking at the difference between sales and purchases. Now, The cost of sales is our purchases. Why? Because the 10,000 here represents old purchases, which is now opening stock, plus new purchases of $150,000, giving us $160,000. We added the transportation for carriage, which is called carriage on purchases, 10,000. It becomes $10,000 plus $150,000 plus $10,000, which gives us $170,000. Then the part of this $170,000 that was returned, which is $2,000, which we call return artwork, was deducted. $170,000 less $2,000 gives us $168,000, which is the cost of goods available for sales. That is the old plus the new and other adjustments. Now, this $168,000 represents the total goods available to be sold. That is the cost price of it. Now, we were able to investigate and find out that it is not all these goods of $168,000 that was sold. The one of $8,000 was still lying in the warehouse, which means that it is the closing inventory or closing stock. Now, we now deducted it from the total available for sales. Since this was the only one that was not sold, and this represents all the goods that was in the warehouse, we now deducted the part of it that was not sold to get the part that was sold. Remember that in this calculation, we are looking at the cost of goods, the cost price, not the selling price. The cost price of all the goods that was sold came to be $160,000. Now, it was these goods that cost us $160,000 that was sold for $359,000, which we have earlier calculated. Now, deducting this cost of goods sold of $160,000 from the sales made from it, which is $359,000, we now obtained $199,000, which can be called the gross profit. At our foundation stage, it is okay for us to understand it here to represent our gross profit. There may be other adjustments which are minor and which are perfectly and purely understandable. We shall look at some of those adjustments as we progress in our studies. Meanwhile, let us look at the next stage in our preparation of the statement of profit or loss account and other comprehensive income. Having gotten the gross profit, the next stage is for us to add to the gross profit what we call other income. What are other income? Other income are income that are not from the main operation of the business. For instance, Victory Enterprises is into the buying and selling of school bags. If they sublet part of their buildings, they could receive rent from those that they gave out part of their buildings to. The income from this rent is not from their main operation of selling school bags. Therefore, it can be regarded as other income. Also, if they have gains from the sales of fixed assets, which we are going to explain later, you will discover that such income is not from the main operation of Victory Enterprises. Also, if there is anything like interest received from any of their activities, such interest received is not part of the income they got from buying and selling of school bags. Such type of income and other income that we will mention later constitutes what we call other income. International Accounting Standard, that is IAS, requires that other income should be shown under a separate headings. So immediately we arrive at the gross profit for the period, the next thing we do is to find out the other income of the organization, if any, and add it alongside with the gross profit before we proceed to the next stage. So for now, let us assume some figures to represent other incomes. Here we are going to take into consideration interest received, profit from the sales of its assets, and rent received. So adding the other income to gross profit, we have rent received with an assumed figure of $10,000. We have interest received $15,000, and profit from sales of fixed assets, $5,000. Now, if you add 199,000 plus 10,000 plus 15,000 plus 5,000 gives us $229,000. Rent received can be as a result of Victory Enterprises giving out part of the business buildings for rent. Interest received can be as a result of interest received from money given to other business organizations for interest, or maybe interest resulting from other operations that are not connected to the main business of the organization. Then we have profit from the sales of fixed assets, which is $5,000. It should also be noted that these items, like the opening stocks, purchases, carriage inwards, return outwards, closing stock, and so on, may not appear in all questions. It depends on the question and what the question contains and what the question wants you to do. For instance, it is possible that we have sales and there is no return inwards, that is sales returns. If there is no return inwards, it means that our net sales will be $360,000 because we are not going to deduct any 1,000 as sales returns. Under cost of sales, it is possible that there is no opening inventory. If the organization has sold all the goods last year or last accounting period, there will be no opening stock or opening inventory. Also, there may not be carriage on purchases. Assume they bought these goods and the company decided to carry it for them to their business premises. They will not be paying any amount as carriage on purchases. So in an exam, you may not have opening stock and you may not have carriage on purchases. Therefore, the purchases becomes the only figure that will stand here, and from it we deduct returns outwards to get our balance. Also, in an exam, they may not be returned outwards. What do I mean? If all the goods we purchased are goods, there will be no need for us to return anyone. Return outwards is as a result of some goods that were defective. So in an exam, they may not be returned outwards, they may not be carriage on purchases, they may not be opening inventory. Sometimes you might have opening inventory, but you not have carriage on purchases. Sometimes you may have carriage on purchases, you may not have opening inventory. Sometimes you may have return outwards, you may not have carriage on purchases and opening inventory. What we mean is that you should be flexible. In some questions, there may not be closing inventory. Closing inventory means part of the 168,000 goods that were not sold. Assuming they sold all the goods, 168,000 will be the cost of goods sold. Also in an exam, other income may not just be rent received, interest received, and profit from the sales of fixed assets. There might be many of them, up to 8 or 9. In some exams, you might just find only one. In some exams, you may not even find any. In such situation, there will be no need for us to include other income. So from the explanation I have given now, it is clear that in answering an exam question, you should be flexible. Gross profit is a profit that is gotten by buying and selling. The difference between sales and purchases gave us our gross profit, and we now added other income. You should understand that in a business operation, by mere buying and selling does not determine your final profit. Of course, Mrs. Victory will incur some expenses in the course of the operation during the year. She may incur some expenses on payment of rent, salaries and wages, hire of plants, telephone calls, stationaries, printing and postage, traveling expenses, depreciation of assets for the period, discounts allowed, bad debt written off, loss on sales of fixed assets, electricities, utilities, and other operating expenses. She may not really incur all these expenses, but these are some of the expenses that may be incurred in the ordinary course of the business. Of course, if you have ever engaged in a business, you discover that mere buying and selling does not guarantee your final profit. It is when you remove other expenses that are regarded as operating expenses within the year that you can now arrive at the profit for the year. We are going to take some expenses into consideration, and these expenses will be deducted from the company's income to determine the final profit, which is known as profit for the year. And the operating expenses of Victory Enterprises may include, among others, salary and wages, hire of plant, telephone, stationaries, printing and postages, traveling expenses, rent, discount allowed, bad debt written off, electricity, utilities, depreciation of fixed assets for the year, loss on sales of fixed assets, other expenses. Salary and wages, this may be the amount Victory Enterprises pays to their workers monthly or weekly or daily. Hire plant, they may hire plants for use or generators for use, and this involves some expenses. Telephone calls or telephone bills also constitutes expenses. Stationaries such as notebooks, pencil, eraser, and so on constitutes stationaries expenses. Printing and postages, when you print some documents for use and make some postages or some postage, it constitutes expenses. Traveling expenses. Some of the workers may need to travel from one place to another to make advertisements, to make people know about the goods, and even to sell the goods. So they may come under traveling expenses. Rent. They may be paying rent for the building they are occupied to do their businesses. Discount allowed. Of course, these are expenses incurred as a result of selling goods to customers on discount. We have treated this under our cash book. Then bad debt written off. These are debts that can no longer be recovered and thus has to be written off as expenses. For instance, if somebody is owing Victory Enterprises and the person can no longer pay because there are some business disasters, the best thing for the business to do is to write off such expenses since they know that the person can no longer pay. This means that some of the sales of 359,000 made can no longer be recovered, as the sales here, that is the revenue of 360,000, contains both cash and credit sales. Some of the credit sales that can never be recovered because the people that owns it cannot pay should be written off as bad debt. We have electricity bills, they consider expenses. Utilities, depreciation of fixed assets for the year. Of course, we have treated this under our depreciation accounting. Loss on sales of fixed assets. An asset that is supposed to be sold for $1,000, if it is sold for $800, then there's a loss on sales of such fixed assets of $200. Loss of sales are usually taken to expenses column as that money has been lost. Then we have other expenses, which may include miscellaneous expenses and many more expenses. In an exam, all these expenses may not come out in one question. More may come out, but as many expenses that you can see here shows that these expenses are expenses that are incurred within the accounting year. Remember, these expenses are called operation expenses. They do not constitute any fixed assets. If you watch here, you will not see something like purchase of plant and machineries, of motor vehicles, purchase of land and buildings, purchase of equipment, purchase of furniture and fittings. These forms of expenses are called capital expenditures and they go to the balance sheet. Of course, we are going to learn more about that now. The expenses you are seeing here are called revenue expenses. They are expenses incurred within the accounting year, and they are expenses that are calculated based on the 12th calendar month. That means the expenses here are just expenses that have been incurred or relate to the accounting year, that is from 1st of January 2021 to 31st December 2021. Any purchase of fixed assets that will last in the business for more than 1 year, 2 years, 3 years, or 4 years, or 5 years does not come out here. So what we do now is to attach imaginary figures or assumed figure to all these expenses, deducting from the gross income. We are going to attach imaginary figures here or assumed numbers or figures here, then add up the whole expenses. Before we take the assumed figures, I'm going to talk a little about depreciation. For instance, if a fixed asset like motor vehicle that Victory Enterprises uses to run the business was purchased for 100,000 US dollars. If scientifically Victory Enterprises knows that this vehicle will last only for 10 years and they can no longer put it into use, the best thing for them to do is to divide $100,000 by the number of years that the motor vehicle will last, that is 10 years. And when 100,000 is divided by 10 years, you obtain $10,000 per year. So what will Victory Enterprises do? Every year, as they are writing off expenses, they will include depreciation as 10,000 US dollars. Why are they doing this? If they continue to remove this $10,000 every year, in 10 years, they will be able to obtain 100,000 US dollars. That means they can now repurchase the asset, which is motor vehicle, when it can no longer function. The purpose of depreciation is to accumulate funds to enable the organization to repurchase such assets where and when they can no longer be put into use. The money written off as depreciation does not constitute outflow of funds. What I mean is this: the money does not go out of the business, it is retained and saved, but taken away from the business as expenses so that it will not go into profit, which will be spent. So, in depreciation accounting, it is a way of providing for the replacement of fixed assets. This 229,000, we brought it upwards here. From this, we deduct all the operating expenses, which includes salary and wages 12,000, hire of plant 1,006, telephone bills 1,400, stationaries 200, printing and postages 3,005, traveling expenses 4,500, rent 8,000, discount allowed 150, bad debt written off 250, electricity 1,600, utilities 900, depreciation of fixed assets for the year 8,500, loss on sales of fixed assets 300, other expenses 400. If you add 12,000 plus 1,006 plus 1,004 plus 200 plus 3,005 plus 4,005 plus 8,000 plus 150 plus 250 plus 1,006 plus 900 plus 8,005 plus 300 plus 400 is going to give us 43,300. All these expenses, we extend it here to be in the same line with 229,000, which we got after adding other income to the gross profit. Now, 229,000 minus 43,300 gives us 185,700. Assuming Victory Enterprises pays tax, that means taxation expenses are involved.